Hello everyone, welcome to the Flip Strategist YouTube channel with Dylan Peacock. Today I'll be talking to you about chart patterns, mainly for the daily and hourly time frames. Let's kick it off with the rounding bottoms. Rounding bottoms occur when a downtrend starts to change to the bullish side. Rounding bottoms are one of the most commonly occurring bullish reversal patterns. The lows of the pattern will start a rounding formation as price moves into a change in trend. Here we can see that there is a downtrend and price retraced to form a resistance area, and as price moved it started to form a rounding formation as you align the lows of price action. The moment the neckline is broken, you can place your trade, and in this case your stop loss would be on the previous low. Here is a perfect rounding bottom example. Downward trend, a small pullback to form a resistance area or neckline, and you can see that there is a big consolidation, so no trades are being placed. As this neckline is broken, the trade is ready to be placed, and you can put your entry long, and your stop loss will be on one of the previous lows if you want a tighter stop there, if you want a longer term stop there. Here we have another one, downward trend, rounding bottom, neckline, break of neckline, entry long. If you have a keen eye, you can see an inverse head and shoulders, left shoulder, head, right shoulder, break of neckline, entry long. Here we have a longer term rounding bottom. You can see it moves up like that from the previous downtrend. There's the neckline. It almost broke the neckline, but it retraced. And if you have a keen eye and you know your patterns, you can see a cup and handle. There's the cup, there's the handle, and as price breaks the neckline, you can place your entry long with your stop loss on the previous low. Here we move on to the cup and handle. The cup and handle is a bullish reversal pattern. It consists of a downtrend from a previous resistance level into a rounding bottom formation. Price must reach the previous resistance level in order to form the cup. A retracement must occur to create the handle, and once price breaks the resistance, the trade can be placed with a stop loss at the bottom of the handle. This is the perfect example of a cup and handle. Downward trend into a rounding bottom into an upward trend, moves to the old resistance area, pulls back to form the handle, and then breaks resistance, and you can place your entry long. Stop loss will be at the low of the handle. Here we have an imperfect cup and handle, however it is still a cup and handle. Downward trend into a rounding bottom, reaches previous resistance, pulls back, 38% retracement hopefully. We generally in the cup and handle want a 38% retracement to a 50% retracement, and then price must break the neckline and we can place our entry long with our stop loss at the bottom of the handle. Here we have another cup and handle. I actually included this little piece here because we can also see an inverse head and shoulders. There's the cup, there's the handle, previous resistance, new resistance, break out of resistance, entry long can be placed, stop loss at the bottom of the handle. Next one is head and shoulders. Everyone knows the head and shoulders. This is a very common pattern that we that we see on the hourly and daily time frames. You could possibly also see it very easily on the 15-minute chart. The head and shoulders pattern is a bearish reversal pattern, consists of a left shoulder, head, and right shoulder, with a neckline drawn aligned with the lowest points to create a breakout entry. So you have an upward trend, forms resistance, pulls back, forms support, moves to break resistance to form the head, fails to hold above resistance, pulls down. You take a trend line, you align these two lows, moves up to form the right shoulder. We can see that the right shoulder and the left shoulder are similarly priced. They're at a similar price level. Price moves down to break the neckline. Price moves down to break the neckline and continues into a downward trend. Here we have an uptrend to form a resistance area, pulls back to form a little support area, pulls back up, breaks resistance to form the head, pulls back to form support. We align the support area with that green trend line, and then price moves up again to form the right shoulder at a similar price as the left shoulder. As price moves down to break the neckline, we place our entry short, stop loss on the right shoulder. Now we go to the inverse head and shoulders pattern. The inverse head and shoulders pattern is used as a bullish reversal pattern. It consists of two consecutive lows, left shoulder and the head. Each time the market rises and makes lower highs, you want to align your trend lines with the highest points. The shoulders may not be lower than the head and must make a defined support area. Once the market breaks the trend line, you can place your entry long with your stop loss on the low of the head or right shoulder. This is a very long-term chart here. This is a weekly chart. We can see that price came down, formed a little support area, pulled back to form a resistance area, came all the way down to form the head, broke the previous support area, fails to hold above support, pulls back to form resistance. We align the two resistance areas with the trend line, and then it comes to form the right shoulder. And as this trend line breaks, we want to put our position long. Stop loss at the bottom of the right shoulder. One, two, three reversal pattern. This is one of my favorite patterns as it commonly occurs on the daily time frames, especially on the indexes. The 1, 2, 3 reversal pattern is a pattern that fails to break support or resistance respectively. 1 is the highest peak or lowest trough. 2 is the retracement that needs to be broken in order to place the trade. 3 is the second highest peak or trough, which fails to break support or resistance. Once the market moves to break out of 2, the trade long or short can be placed. Here is an example of both. Uptrend, pullback, moves back up, fails to break resistance, and then falls back down, breaking previous support, and then you can place your entry short with your stop loss at the previous high. Here we have a downtrend, a pullback, another pullback, and then it moves further up, breaks to allowing you to place your entry long with your stop loss at 0.3 or previous low. Here we can see it on a normal chart, downward trend to form 1, pulls back to form 2, 2 becomes neckline, makes a third peak, and as price breaks this neckline, you want to enter your position long. Here we have an upward trend, pulls back to form support, pulls back up, doesn't break resistance, and pulls back down, breaks the neckline, and you can place your entry short with your stop loss at the previous high. Double bottoms. Okay, double bottoms is a tricky one on the daily and weekly time frames, daily and hourly time frames. Sometimes it can be really misinterpreted and people don't necessarily understand the rules. Double bottoms are used as a reversal pattern from bearish to bullish. A common misconception is that the pattern is formed as price reaches a previous support level. The fact is there must be a retracement to form a resistance level. The price must move within the same price range of the previous low and then move upward to break out of the resistance area. Here we can see that there is a downtrend, pulls back to make a resistance area, touches the same price as previous support, and then we have a nice big green candle to break out of resistance. The entry long is ready to be placed, and your stop loss will be at the double bottom. Here we have a very big consolidation. Here we have a downward trend to form support, an upward move to form resistance, a downward move to touch the previous support area or price action, and the market breaks out of resistance and your trade is ready to be placed. Your stop loss will be at the bottom of the double bottom. Here you can see the same thing, a nice consolidation. Here the same, a nice consolidation. As it breaks out of that resistance area, you can place your entry long. And the same here, as it breaks out of that resistance, you can place your entry long. Rectangle bottoms. Rectangle bottoms are formed after a previous downtrend into a consolidation. The highs and lows form a rectangular formation using parallel trend lines. The pattern can break out to the bullish or bearish sides. It can be used as a bearish continuation or as a bullish reversal. Here we can see a downward trend. Generally with rectangles, you want 2 to 4 touches. Here's one touch, second touch, third touch, fourth touch, fifth touch, and it breaks out to the upside and you can place your entry long with your stop loss at the bottom of these lows. Here we have a very long-term rectangle bottom. You can see that it touches many times. This is on the weekly time frame. You can see that as price breaks that rectangle resistance, you can place your entry long with your stop loss on the lows. Here we have a very nice rectangle bottom. Trend comes down, touch 1, touch 2, touch 3 at the top, breaks out, place your entry short, stop loss at the highs. Here I have an example with moving averages. Downward trend, 8 is below 21, touch 1, touch 2, touch 3, touch 4. Moving averages cross to the upside, 8 above 21. As it breaks out of resistance, you can place your entry long and your stop loss can be on the previous low or at these main lows at the double bottom. Remember, this is the double bottom because previous resistance has been broken. Rectangle tops. Rectangle tops are exactly the opposite of rectangle bottoms. They occur at the top of a trend and they can be used as continuations or as reversals. Upward trend, touch 1, touch 2, there's touch 3, no touch, touch 4, break to the upside. You can enter your position long with your stop loss on the previous low or at the lowest points of the rectangle. Here we have an upward trend, touch 1, touch 2, touch 3, touch 4, break out to the downside, enter your position short, stop loss at the top of the rectangle. And here we have a longer time frame on the daily. You can see that there was a big move up, didn't touch, but it touched there, didn't touch, touched over there, touch, touch, and as it breaks out of the rectangle, we want to enter our position long, stop loss on the previous low or at the bottom of the rectangle. And finally, we have the 3 rising valleys. I personally love the 3 rising valleys as they can really show potential to the upside. The 3 rising valleys pattern consists of 3 higher lows and 3 highs. Nice thing to know is that the highs do not have to be higher than the previous highs. However, the breakout entry will be a break of the highest peak or valley, 1 or 2. Once the high of Valley 3 breaks the neckline, the trade is ready to be placed. The valleys must be similar in width, either sharp or wide. Here's a nice example. You can see that this is a valley, this is a valley, and this is a valley. 1, 2, and 3 is the higher lows, and the highest peak. And the highest peak here is the confirmation of the long position. Here we have a downtrend, form support, Valley 1, Valley 2, Valley 3, low 1, higher low number 2, higher low number 3, highest peak breaks, enter your position long, stop loss at the low of number 3. Downward trend, makes a low, Valley 1, moves up, pulls back, makes a low, higher low, moves up to form resistance, pulls back to form low number 3, 1, 2, and 3 higher lows, break of resistance, enter your position long, stop loss at the bottom of low 3. Here we have nice valleys, 1, 2, 3. Notice that the highs are not higher than previous highs, but the lows are lower. Sorry, the lows are higher than previous lows. As resistance breaks, you want to enter your position long with your stop loss on the previous low. In this case, the low is lower than the third low, so we will be putting the stop loss there. Thank you everyone for listening to the chart patterns video. I hope you enjoyed it. Please feel free to ask questions. I hope you have a good day. Trade safely. If you do have questions, contact me, Dylan, or Warren, and visit our website, thefibstrategist.co.za. Thank you for your time. Have a good one.